On February 5th, during their earnings call, Amazon dropped a bombshell on Wall Street. They projected a CapEx spending of $200 billion, which was roughly $50 billion higher than what Wall Street analysts expected. To put that in perspective, Amazon is going to spend more money than the entire GDP of countries like Cuba, Kenya, or Ukraine. That's a massive jump of 52% from last year, and Wall Street's response was quick and brutal. Amazon stock opened around 9% lower the next day and kept sliding for 5 straight trading sessions. And the stock is down roughly 20% since the beginning of this month, which in numbers translate to losing around $450 billion in market value in a couple of weeks. But instead of panicking, this is the time to gather information on how this spending will affect the company and its stock. In this video, we are going to do exactly that. Where Amazon's $200 billion is going, why investors are terrified, and most importantly, what the realistic outcomes look like for this year and beyond. If you own Amazon stock, or if you're thinking about buying the dip, or maybe you just want to understand the biggest CapEx story in tech right now, this video is for you. Let's start with the raw facts from February 5th earnings call. Amazon's Q4 2025 numbers were actually very solid. Total net sales hit $213.4 billion, up 14% year over year, and beating estimates. AWS revenue came in at $35.6 billion, up 24%, the fastest growth rate in 13 quarters. AWS operating income was strong, and the backlog, which is the future committed revenue, exploded to $244 billion, up 40% from the previous year. Then came the guidance that changed everything. CEO Jassy said, and I'm quoting directly, "With such strong demand for our existing offerings and seminal opportunities like AI, chips, robotics, and low Earth orbit satellites, we expect to invest about $200 billion in capital expenditures across Amazon in 2026. And we anticipate strong long-term return on invested capital." That single sentence changed the entire narrative around Amazon overnight. According to Amazon's commentary and analyst breakdowns, the money breaks down roughly like this. 78 to 82%, which is roughly $160 billion, is going straight into AI infrastructure, which includes building and expanding dozens of new hyperscale data centers across US, Europe, and Asia, installing massive liquid-cooled systems because new AI racks now consume 120 to 200 kilowatts each, which is 10 to 20 times more power than traditional servers, deploying high-speed networking gear to connect thousands of GPUs inside training clusters, ramping up productions of Amazon's own custom AI chips, Trainium and Inferentia, so they can reduce reliance on NVIDIA and lower long-term costs. Another 10 to 12%, which is roughly $22 billion, is going towards power and electrical infrastructure. Amazon is signing huge deals for new substations, transmission lines, and even renewable energy projects because these AI data centers are extremely power hungry. Some new campuses will need 200 to 500 megawatts each, enough to power a medium-sized city. Then 5 to 7%, which is roughly $12 billion, is earmarked for robotics and warehouse automation. Amazon is already the world's largest robotics operator, and they plan to deploy hundreds of thousands more robots in 2026 to keep fulfillment centers efficient. The final 3 to 5%, which is roughly $8 billion, is going to Project Kuiper, which is Amazon's satellite internet constellation, which will compete directly with Starlink. To put the massive scale in perspective, in 2023, Amazon spent $53 billion on CapEx. In 2024, it became $85 billion. In 2025, it was $132 billion. And now in 2026, it is $200 billion. That's nearly a 4x increase in just 3 years. Matt Garman, CEO of AWS, was very direct on the call. And he said, "We are still very supply constrained on the AI side. Even with this level of investment, we expect to remain capacity constrained for the next couple of years." Translation: demand for AI cloud capacity is so strong that Amazon is willing to spend $200 billion just to catch up and stay ahead. They are building at a speed and scale never seen before in the cloud industry. And the market's immediate reaction was pure fear. Which brings us to the second part of this video. The sell-off wasn't just knee-jerk. There are 3 very real, very legitimate concerns that Wall Street is wrestling with right now. The biggest concern is that free cash flow is being destroyed. Investors have loved Amazon for years because it generates enormous amounts of cash that can be used for buybacks, acquisitions, or simply sitting on the balance sheet as dry powder. Unfortunately, that era is temporarily over. In 2025, Amazon's trailing 12-month free cash flow already collapsed from $38.2 billion to roughly $11.2 billion because of higher CapEx. For 2026, with $200 billion in CapEx and operating cash flow expected around $140 to $155 billion, multiple top analysts such as Morgan Stanley, Bank of America, JP Morgan are now forecasting negative cash flow, anywhere from negative $10 billion to negative $28 billion. When free cash flow goes negative, companies have 3 choices: issue new debt, which Amazon is already doing, slow down or pause share buybacks, and dilute shareholders with new equity, which seems unlikely for now. None of these are popular with long-term investors who bought Amazon expecting consistent cash generation. And Amazon making any of these three choices will only further damage investor confidence. Now, concern number 2. $200 billion is an astronomical number. Even the CEO admits these investments will take time to pay off. During the earnings call, when pressed on timing, Jassy said returns would be strong over the long term, but he deliberately avoided giving specific numbers. Investors are now asking the tough questions. How long will these new data centers sit partially empty before they're fully utilized? Will Amazon's custom Trainium and Inferentia chips actually take meaningful market share for NVIDIA, or will they remain niche? What if enterprise customers are slower to adopt generative AI than expected? And nobody at Amazon seems to be answering these questions. Right now, even with all this pending, AWS is still supply constrained. Customers are waiting months for capacity. That's great for the backlog, but it means revenue recognition is delayed while the cash is being spent upfront. Finally, concern number 3. Amazon isn't the only one spending like crazy. Google is projecting $175 to $185 billion. Microsoft is at $145 to $150 billion. Meta is standing at $115 to $135 billion. Total hyperscaler CapEx in 2026 is heading towards $700 billion. It feels like a classic arms race where everyone is terrified of falling behind. If one player slows down or if AI demands disappoints even slightly, the entire group could face a painful reckoning. That's why the stock has been punished so severely. The market is pricing in the risk that Amazon is overinvesting at exactly the wrong time. Now let's move past the fear and look at what's actually most likely to happen. Based on the current $244 billion AWS backlog, analyst models, and industry trends, here are the 3 realistic scenarios for Amazon over the next 3 years. Base case, which is most likely, with around 65% probability. This is the scenario management is guiding toward, and what I personally believe is most probable. Throughout 2026, Amazon spends the $200 billion aggressively. New data centers start coming online in waves, first in Virginia, Ohio, and Oregon in Q2 and Q3, then bigger campuses in Europe and Asia by year-end. Liquid cooling systems are installed at scale, and the first batches of Trainium 4 chips began shipping to internal teams. By Q4 2026 and especially Q1 2027, the $244 billion backlog starts converting into actual revenue at an accelerating pace. AWS revenue growth reaccelerates from 24% in 2025 to 28 to 32% in 2027. Operating margins, which dipped in 2026 due to heavy depreciation, begin expanding again in the second half of 2027 as utilization rates climb above 75%. Free cash flow bottoms out around negative $15 to $20 billion in 2026. Then swings back to positive $25 to $35 billion in 2027 and climbs towards $60 billion by 2028. Return on invested capital gradually improves to the mid-teens, exactly as ND Jassy promised. For the stock, it stays volatile through mid-2026, but once investors see AWS growth reaccelerate and free cash flow turn positive, the sell-off ends. The stock begins a steady recovery, potentially rising 35 to 50% from current levels by the end of 2027. This is the slow grind higher scenario. Not super exciting in the short term, but very rewarding for patient investors. Now, the bull case, where everything goes right, which has a 20 to 25% probability. This is the dream scenario for Amazon bulls. AI adoption explodes faster than expected, especially agentic AI systems, enterprise copilots, and large government contracts. Companies realize they need massive amounts of secure private AI infrastructure and choose AWS because of Amazon's track record with compliance and custom silicon. Trainium 4 and new Inferentia chips turn out to be slightly cheaper and more efficient than NVIDIA's offerings in many workloads, allowing Amazon to win back share and dramatically improve gross margins. AWS revenue growth hits 35 to 40% in 2027 and stays in the mid-30s through 2028. Data centers reach 85 to 90% utilization within 12 to 18 months instead of 24 to 30 months. Free cash flow recovers much faster, turning positive by mid-2027 and reaching $80 to $100 billion annually by 2028. The stock reacts like it did during the early AWS days. It doesn't just recover, it rips higher. We could easily see Amazon's market cap add $1 trillion between 2026 and 2029. Making it one of the best performing mega cap stocks of the decade. This is the scenario where Amazon cements itself as the undisputed infrastructure king of AI era. Finally, the bear case, where things go wrong, which has a probability of around 15 to 20%. This is the nightmare scenario that the market is currently pricing in. AI enthusiasm cools down dramatically in 2026. Enterprises delay big AI projects because of cost, complexity, or regulatory uncertainty. Competition from Microsoft, OpenAI, and Google becomes fiercer than expected, eating into Amazon's market share. Many of the new data centers come online but sit at at 50 to 60% utilization for longer than planned. Depreciation and interest expense from the massive debt issuance keep margins compressed. Free cash flow stays negative or barely positive through 2027. AWS growth slows to low 20% range and the stock gets heavily derated, potentially trading at a forward PE ratio in the low 20s. Amazon is forced to dramatically slow CapEx in 2027 and 2028. Losing momentum in the AI race and allowing competitors to pull ahead. In this case, the stock could trade sideways or down 15 to 25% from current levels for 2+ years. A painful but survivable outcome for a company as strong as Amazon. Right now, after the recent sell-off, the market is pricing in something closer to the bear case. That creates the opportunity. If you believe the base or bull case is more likely, which I do, Amazon is looking very attractive at today's depressed valuation. Personally, I believe in the base case. The $244 billion backlog and accelerating AWS growth are real. Demand for AI infrastructure is not fake. Yes, $200 billion is expensive, but this is the cost of staying dominant in what will likely be the largest technology platform shift of our lifetime. I believe Amazon will come out the other side stronger, just like they did after the heavy AWS investments in the 2010s. If you're a long-term investor with a 5+ year horizon, the current weakness in Amazon stock looks like a rare chance to buy one of the best businesses in the world at a more reasonable valuation. If you're a trader or have a shorter time horizon, expect continued volatility through at least mid-2026 as the market digests the spending numbers quarter by quarter. And if you believe in the base case, then dollar cost averaging would be the right thing to do. Don't forget to watch 3 key metrics in the coming quarters: AWS revenue growth, backlog conversion rate, and comments on Trainium adoption. Also, consider pairing Amazon with some of the suppliers, for example, Vertiv, Arista, Sandisk, Micron, etc., to balance the risk, because that's where most of the CapEx money is going. Amazon's $200 billion 2026 CapEx is the boldest single-year investment bet in modern business history. It's risky, it's expensive, and it has already cost the stock dearly in the short term. But history shows that when Amazon sees a secular opportunity, they go all in, and they usually win. The next 12 to 18 months will be bumpy, but if AWS continues to execute, this could be remembered as the moment Amazon secured its position as the infrastructure backbone of the AI era. What do you think? Is Amazon's $200 billion move brilliant long-term investing or dangerous overreach? Please drop your thoughts in the comments. If you stayed so far and this video helped you understand the situation better, please hit the like button and subscribe to Neural Net Worth. Thanks for watching. I'll see you in the next video. Until then, take care and invest wisely.